All right. Thank you, Jessica. So good afternoon, everyone. As I'm sure you're already aware, student loans have been a hot topic in the news recently. So our goal today is to update you on what's going on and how it may impact you. Please note that we're not going to be reviewing the basics of any of the existing programs related to student loans, since this is an update presentation rather than an introduction or overview. We know that there will be questions, so please do share them in the question and answer function. We highly encourage folks to use the upvote function. That'll help us prioritize what to answer at the end. We anticipate that there probably will be lots of questions. And as a reminder, please do not share any personal information in this forum. Keep your questions general without kind of revealing personal information. Next slide. The Office of the Student Loan Advocate is small but mighty, consisting of myself, Amber Hay, serving Washingtonians as the Public Service Loan Forgiveness Advocate, as well as my colleague and mentor, Jessica Manfredi, who is the Student Loan Advocate. Our office is housed under WASAC's, the Washington Student Achievement Council's Consumer Protection Division, which protects higher education consumers in Washington. Before we dive into our material, we do have a few housekeeping items to share. As you may have already noted, the presentation is being recorded and will be posted onto the Student Loan Advocate webpage, as we do with all of our public webinars. We will provide our slides for your reference following the presentation, so you can have access to all of the links we've embedded. It may take up to a week for us to get the materials posted online, as well as emailed out to all of the registrants. The chat is disabled for participation. It's only to be used by panelists to share links and resources throughout the presentation. All participants are muted, so you won't be able to come off mute today, but you can, again, use your Q&A function to enter your questions. So we'll plan to get those towards the end. Use the upvote function, particularly if you see someone that has the same question that you have, click that little upvote button. And finally, we have live closed captions that you can enable on your Zoom window yourself. To give you a little bit of background on this work, the Office of the Student Loan Advocate was created in 2018 through state legislation. In addition to creating our office, this law also established a Student Loan Bill of Rights for Washingtonians. This Bill of Rights allows Washington to enforce state consumer protection laws against student loan servicers, which is actually facilitated by our partners at the Department of Financial Institutions. It also allows Washington student loan borrowers to submit their questions and complaints directly to our office to get individual assistance and resources with their student loans. Something that we want to highlight about our office is that we also act in an advocacy role. So that means that we can make recommendations for changes at the local, state, and federal level regarding student loan problems and related issues. And so we're empowered to act on behalf of borrowers, which is actually one of the things that we love most about our office. And honestly, right now is one of the most important aspects of our office in this current student loan landscape. Today, we intend to cover general updates related to federal student loans, the upcoming changes to repayment options stemming from the recent reconciliation bill, as well as other student loan updates from the bill. We'll use that term reconciliation bill. It's also that One Big Beautiful Bill, or HR 1. Those are kind of the other names, but we'll refer to it as the reconciliation bill just for clarity. We intend to give you some action items and cover some frequently asked questions that we anticipate many of you may have. And finally, we'll review how you can contact our office for assistance if needed. Please note that this information is up to date as of today, September 17th, and may change in the future if you're watching this recording later on. And again, we're going to be recording and sharing this publicly. All right, so let's dive right into the general updates in this in the student loan landscape. So back in March, the Department of Education laid off around half of its workforce. And so this over the last few months has led to longer wait times for borrowers that have submitted cases with the FSA or Federal Student Aid Ombudsman Office. In general, we're concerned that these staffing cuts may lead to less servicer accountability and more delays that hurt borrowers. So we're kind of on the lookout for those things. As announced in May, the Department of Education has resumed collections on defaulted student loans for the first time since 2020. The department reports that most of the collections thus far have been through the Treasury Offset Program, which has primarily impacted like tax returns. If you are in default, please check out the link that's going to be on this slide that says, get out of default when we send out that slide deck and recording for more information. The Department of Education, as directed by an executive order early this year, has been working through what's called the negotiated rulemaking process to attempt to regulate employer eligibility for the Public Service Loan Forgiveness Program. The proposed regulation language was posted last month, and actually its public comment period closes today. We anticipate that the final regulation is going to be published in time for implementation for July 1, 2025. However, we recognize that it is likely to be challenged through litigation prior to its actual implementation. So please know that our office has worked behind the scenes to provide comments and engage in this negotiated rulemaking process, and that as of right now, nothing has changed with regards to PSLF employer eligibility. At the end of 2025, borrowers who earn debt forgiveness under the income-driven repayment forgiveness could be hit with a tax bill on that amount forgiven. So again, this is specific to income-driven repayment forgiveness, not PSLF. This potential tax bill, this is due to an expiring benefit under the American Rescue Plan Act that made IDR forgiveness tax-free. Borrowers who are concerned about this potential tax bill could choose to opt out of the IDR forgiveness at the time that they reach it. And just kind of as a reminder for folks, IDR forgiveness is only available under the income-based repayment plan known as IBR. Processing of IDR forgiveness is on pause due to some recalculations being made on behalf of FSA. That's in relation to the SAVE litigation. So we don't have an estimate for when processing of forgiveness under IBR will resume. So that's something to kind of keep an eye on. And we'll go to the next slide. Speaking of processing, you may also be aware that there is a significant backlog of IDR applications, approximately over 1 million applications right now. Many folks have been waiting several months for processing of their manually submitted IDR applications from when they may have submitted them when the online application was not available in the past, 6 to 12 months. So borrowers that are still waiting on those applications to be processed may consider submitting a new application online through the studentaid.gov website using the IRS data retrieval tool in an attempt to get faster processing. Millions of borrowers have been on an interest-free forbearance for the last year due to the ongoing SAVE court cases. As of August 1, 2025, interest has resumed accruing on those loans for borrowers that are still in that forbearance. Borrowers may want to consider applying to change their IDR plan if they want to go ahead and restart payments in order to continue working towards PSLF or IDR forgiveness. And we are going to talk a little bit more about options for folks that are in the SAVE forbearance later in the presentation. Another kind of general update. So recently, the Total and Permanent Disability Discharge Program, also known as TPD, transitioned over to be administered by Federal Student Aid and its vendors. TPD applications can be submitted and tracked directly through studentaid.gov. If you are encountering application difficulties with this particular program, stay tuned for more information on how to connect with our office for assistance. And our final general update, the Joint Consolidation Separation process and application is available now. Borrowers who are struggling with their joint consolidation loans can apply to separate their loans and potentially receive significant benefits that were previously unavailable to them. So if you're in that boat, encourage you to look in that process and maybe contact your office for assistance. And I'm going to pass it over to Jessica to talk a little bit about repayment plans.
Thank you, Amber. Good afternoon, everybody. I know that Amber introduced me earlier, but in case you might have missed it because you were a little late, my name is Jessica Manfredi. I'm the student loan advocate here for Washington State, and I'm going to be talking to you about some really important updates related to repayment options. So I would like to start by saying that the reconciliation bill that Amber mentioned earlier, which is also known as the One Big Beautiful Bill Act, will change a lot when it comes to student loan repayment. So to give you a little bit of background, in July of 2025, President Trump signed into law a massive legislative package that restructured the federal student loan repayment system. And what this law does is that it divides borrowers into two categories based on when a borrower took out their loans. So borrowers who only took out loans before July 1st of 2026 will retain access to some existing repayment plans, but will lose access to others. And we're going to give you more detail on what that is. And borrowers who take out loans after July 1st, 2026, will have less generous options and just fewer options for repayment in general. We have broken down the section to talk about repayment plans basically by these dates so that you can understand them better. So we're basically going to talk about the repayment plans that are currently available for borrowers and the repayment plans that will be available for future borrowers once the reconciliation bill is implemented. So let's do a quick review of what I'm going to be referring to as legacy repayment plans, which are available for current borrowers who only took out loans before July 1st, 2026. So for borrowers who only took out loans before July 1st of 2026, there are 5 main types of standard and alternative repayment options. The standard and alternative repayment options do not take into account your income, right? So these plans also don't typically lead to forgiveness, and instead the borrower repays the entire loan balance and any accrued interest over a defined number of years. There are the fixed repayment options, which include the standard, extended fixed, and 30-year standard repayment plans. And there are also 2 graduated repayment options, the graduated and extended graduated repayment plans. And again, these plans are only available for borrowers who took out loans before July 1st of 2026. All right, moving on to talk about those repayment plans that are dependent on, borrower's household income, the repayment plans that are known as income-driven repayment plans or IDR plans. I'm going to be referring to them as IDR for the most part moving forward. So these are repayment plans that are designed to, for most people, be affordable based on your income and family size. And unlike the standard repayment plans, in the alternative repayment plans that I talked about earlier, there's typically forgiveness after a certain number of years in repayment, depending on the repayment plan that you're under. For borrowers who only took out loans before July 1st of 2026, in some cases, your monthly payment under one of these plans could be as low as $0 a month. There are 3 IDR plans that remain available for borrowers: the income-based repayment plan, or IBR, the pay-as-you-earn, or payee plan, and the income contingent repayment plan, ICR. When it comes to forgiveness, the only income-driven repayment plan that will lead to forgiveness at this time is the income-based repayment, IBR plan. IDR forgiveness under the payee and ICR plans are currently blocked due to the ongoing lawsuit that's challenging the SAVE plan and some other IDR provisions. Borrowers can still be on the payee and ICR plans, however, and qualify for public service loan forgiveness if they are working at a qualifying employer, right? So you can no longer get, at this point in time anyway, forgiveness under payee or ICR if you're working under income-driven repayment forgiveness. But if you are on public service loan forgiveness, you could still be under these plans and still get credit towards forgiveness. Now, there are a few important things that current borrowers need to keep in mind about IDR options, right, and repayment plans. First, as Amber mentioned earlier, if you're wondering what happened to the Saving on Available Education Plan, the SAVE plan, which was previously known as the Repayee plan, it is currently blocked from operating due to an ongoing court case that is challenging the plan. It is our personal opinion and that of many advocates across the country that the SAVE plan is not going to survive this lawsuit, right? So borrowers that are currently under the SAVE plan should really start exploring other repayment options. All borrowers enrolled in the SAVE plan are currently in a forbearance. And like Amber mentioned earlier, interest began accruing for borrowers that are in that SAVE forbearance on August 1st of this year. Public service loan forgiveness, known as PSLF, and IDR credits are not being granted for any time that people are spending in SAVE, right? There are some options for you to get credit in the future, potentially, for PSLF specifically, but as of right now, you're not getting any credit if you are on that SAVE forbearance. Now, moving on to talk about pay and ICR, both of these plans will no longer be available for new enrollments as of July 1st of 2026. Those that are enrolled into those two plans at that point in time will be able to remain on the plan for the time being, though they will eventually be phased out, and we're going to talk about that in a little bit. The only legacy income-driven repayment plan that will remain available for current borrowers after July 1st of 2028 is the income-based repayment IBR plan. In other words, current borrowers will continue to be able to enroll in and remain in IBR as long as, this is really important, they don't consolidate or take out any new loans, right? If you consolidate or take out any new loans, then you're no longer going to have access to IBR or any of the other plans that we've mentioned so far. All right. Now, we'll switch to talk about the new repayment plans, which will be implemented due to the reconciliation bill and will be the only options available for borrowers with loans disbursed or consolidated after July 1st of 2026. The reconciliation bill replaces all existing repayment plans into two new plans, the new standard plan and one new income-based repayment plan, which we're going to talk about in a little bit. For new borrowers, the new standard plan is going to collapse all the existing standard, graduated, and extended plans into one with fixed monthly payments and different repayment terms based on the borrower's total outstanding principal at the time they enter repayment. Terms are going to vary for this new standard repayment plan from 10 to 25 years, depending on the total outstanding balance when the borrower entered repayment. In other words, the higher the balance, the longer the repayment term. The repayment term starts at 10 years for borrowers with up to $25,000 in debt and increases gradually until 25 years for borrowers with over $100,000 in debt. When it comes to the new income-driven repayment plan option, the repayment assistance plan, or the RAP or RAP plan, it will be the only income-driven repayment option, once again, available for new borrowers. Borrowers enrolled in the RAP plan will be required to pay 1 to 10% of their adjusted gross income, as you can see on this chart. There will no longer be $0 monthly payments available for borrowers, the new borrowers that enroll into this plan. Borrowers will be required to make minimum monthly payments of $10, even if they have no income. The monthly payment under RAP will be reduced by $50 per dependent child, though you should note that, you still are going to be required, even after deductions, to make at least a $10 minimum monthly payment. And on this plan, any loan balance that remains after 30 years of on-time monthly payments is discharged, which is an increase from all prior plans whose maximum terms range from 20 to 25 years for forgiveness. RAP or RAP does come with some benefits for borrowers. So under RAP, if a borrower's monthly payment is not enough to cover the accruing interest, the federal government subsidizes the unpaid accrued interest so that the balance is always decreasing rather than ballooning. This provision is intended to address negative amortization, in which a borrower's income-based payment is too low to cover the interest accruing on the loan, making their balance grow even as they make consistent monthly payments. The RAP plan also includes a principal subsidy to ensure that the borrower's principal balance decreases each month, even if the payment is too low to reduce their principal. In other words, if a borrower's monthly payment does not reduce their principal balance by at least $50 per month, the federal government is going to kick in enough to make sure that their principal decreases by at least $50 every month. Now, there's some important things to know about the RAP plan. The RAP plan will not be available for borrowers with Parent Plus loans. This means that the new standard repayment plan will be the only option available for new Parent Plus borrowers, effectively eliminating Parent Plus borrowers' eligibility for IDR forgiveness and severely limiting the access for public service loans forgiveness for new loans taken on or consolidated on or after July 1st of 2026. Now, the RAP plan will increase the monthly payment for most borrowers when compared to legacy IDR plans. Some people might see a reduction in monthly payments if they opt into this plan, but the majority of folks that were in legacy repayment plans will likely see an increase. And borrowers that are enrolled in SAVE, PAYE, and ICR will automatically be enrolled into the new repayment assistance plan if they do not select another plan by July 1st, 2028, right? So if you're in SAVE currently, PAYE, or ICR, and you don't do anything by July 1st of 2028, you're going to be automatically enrolled into RAP as long as there is income information available to enroll you into the program. All right, so you might be asking, this is a lot of information, Jessica, right? How do I go about trying to figure out all of my repayment options, right? You can get help picking a repayment plan, whether it is a standard, alternative, or an income-driven repayment plan using the loan simulator tool. If you already have federal student loans, you can log in using your FSA ID username and password, and it will pull your actual student loan data, balances, and ask you questions about your household income and size. And based on that information, it is going to calculate for you an estimated monthly payment under different repayment plans. Please note that our office does not provide monthly payment estimates for borrowers. So if you're looking for an estimate under different repayment plans, please use the loan simulator or contact your servicer directly to ask for an estimate. It's also important for you to note that the loan simulator currently only has the legacy plans available, right? So it doesn't have RAP, it doesn't have the new standard repayment plan, and we don't really know when that's going to be available. But if you want to at least review your options that are currently available to you right now, you can do so using the loan simulator. Now, before moving forward to the next section, I just want to make sure that we take a pause here, and then I will go ahead and pass it back to Amber. I'm sorry. I'm not passing it back to Amber. I'm sorry. I'm getting confused with my notes here. So I'm actually going to give you, before I pass back to Amber, a recap on all the information that I shared, right? Because I've shared a lot of information. So, all right. I just want to quickly repack some of the most important dates, right, regarding repayment plan availability. So for the new standard, for the standard and alternative repayment plans, right now, there's basically no changes to the current system. Everything is going to remain the same. The main changes to those systems is going to start on July 1st of 2026, where new loans, right? So if you take out a new loan, or you consolidate a loan after July 1st of 2026, you will only be eligible for the new standard plan. Now, older loans, meaning pre-July 1st, 2026, will continue to have access to the current 10 and 30-year standard plans and the alternative plans. And then right now, there's no further changes when it comes to the July 2028 date for standard and alternative plans. And here is a recap of the upcoming changes to Income-Driven Repayment Plan, or IDR. Right now, access to all IDR plans, except for SAVE, remains the same, right? So you can still apply for payee, ICR, IBR, just not the SAVE plan. Now, when you're looking at July 1st of 2026, beginning on that date, no one will be able to apply for the payee or ICR plans. So if you want to get into payee or ICR, you have to take action now. Now, the income-based repayment plan, or IBR, will remain an option, right? So if you don't get into payee or ICR, but you want to get into an income-driven repayment plan, IBR will still be an option for you, again, as long as you don't take out any new loans or you don't consolidate any loans after that July 1st, 2026 date. Now, it's important for you to know that the IBR plan, as long as you only have loans prior to July 1st of 2026, will continue to be an option for you and will not be phased out. Now, when looking at the July 1st, 2028 date, ICR and payee will be phased out by that date at the latest. And like I explained earlier, if you are a borrower enrolled in one of those plans and you don't take action, your loans will be moved to a plan that the Department of Education determines is the best for you. All right, now I'm going to pass it over to Amber.
Thanks, Jessica. Take a breath. That was a hefty section. So thank you for reviewing the upcoming changes to the repayment options that borrowers will have. We are now going to shift gears to talk through some of the other impacts the recent reconciliation bill will have on borrowers and student loans. The new law makes unprecedented cuts to our federal financial aid system and fundamentally changes the options that millions of borrowers rely on to affordably repay their loans. We anticipate that this reconciliation bill will likely make paying for college even more expensive, potentially pushing families into more costly and risky private student loans, as well as spike monthly student loan bills for millions of working families. These are big changes to the student loan system and will already make this already complicated system even more difficult to navigate. So hopefully the information we're providing today will help you with that navigation. Jessica, if you could, thank you. All right, so although many of the elements of the new reconciliation bill have implementation dates over the next few years, the Department of Education has indicated that it's moving to immediately implement certain provisions. So I'm going to go ahead and cover what those immediate implementation provisions are. So first, the partial financial hardship requirements to enter income-based repayment, or the IBR plan, is going to be removed, which will allow more borrowers to qualify to switch to IBR. Previously, borrowers may have been denied for IBR due to not meeting that partial financial hardship requirement. And so, if you want to switch or you've previously been denied when trying to get into it, you may want to reapply. We do recognize that the online IDR application has not been updated to reflect this change, and we're not sure when it will be updated. So you may need to contact your servicer for assistance getting into IBR. Additionally, borrowers who have already consolidated or who have consolidated their Parent Plus loans will be able to access the income-based repayment plan. Previously, borrowers with the consolidation loans that repaid Parent Plus plan loans could only access income contingent repayment, or ICR, but they will now be able to access IBR. However, the system also does not currently allow these borrowers to enroll in IBR yet. We've been told that the department will update studentaid.gov when it is available. In the meantime, these borrowers may want to enroll or stay on ICR to ensure that they are on an income-driven repayment plan before July 1, 2026, in order to maintain that access to income-driven repayment. Another element that the department has opted to implement immediately is to reduce the amount of loans a student can borrow for this academic year and moving forward if they are enrolled as a part-time student. This reduction is in the annual loan limit that a student can borrow and will be made in direct proportion to the degree to which a student is not full-time. So for example, that might look like if a borrower is enrolled half-time, they may only have access to half of the annual loan limit. All right, the first big date for implementation of the reconciliation bill, as we've said plenty throughout the presentation, is July 1, 2026. Let's recap some of the changes that will occur on that date. To start, any borrower with a new loan dispersed on or after July 1, 2026 will only have two repayment options, the new standard plan and the new repayment assistance plan, or RAP, that Jessica covered earlier. This limitation on repayment plan options also includes current borrowers with existing loans who take out any new loans or consolidate their loans after July 1, 2026. So this means that borrowers with current loans should carefully consider these new repayment options before taking out any new loans or consolidating after that July 1, 2026 date. Current borrowers with only loans taken out before July 1, 2026 will continue to have access to IBR, ICR, and payee. However, ICR and payee and the save forbearance, if it hasn't disappeared by then, will phase out by July 1, 2028. In addition, current borrowers with only loans enrolled in the legacy repayment plans, like the 10-year standard, extended, and graduated, right? Those legacy, standard, and alternative repayment plans will actually be able to remain on those plans. So that's important to know. I think I saw a question in the chat about that specific topic. Let's go ahead and, oh, you already changed the slide for me. Perfect. Parent Plus loan and borrowers with loans taken out on or after July 1, 2026 will only have access to the new standard repayment plan. Current Parent Plus borrowers will lose access to income-driven repayment options if they don't consolidate their current loans before July 1, 2026. This means that current Parent Plus loan borrowers should consolidate as soon as possible if they want to retain that option to repay their loans under an income-driven repayment. Current borrowers with loans taken out before that July 1, 2026 can remain on their income-driven repayment plans, but need to switch to IBR or RAP by July 1, 2028 in order to remain eligible for PSLF or IDR forgiveness. Okay, we talked a lot about repayment plans. So besides those, there's also some upcoming changes to certain forbearance and deferments. Specifically, so for borrowers that take out loans after July 1, 2027 will not be able to use the economic hardship or unemployment deferment to pause their payments if they cannot afford them. Current borrowers with loans taken out before that date will still have access to those deferment options. Additionally, loans made on or after July 1, 2027 will be eligible for forbearance for up to 9 months within any 2-year period. That is a substantial change to the current rules, which allows for 12 consecutive months of forbearance with a cumulative limit of 3 years. Okay, so the bill also sets new loan limits for both graduate and parent borrowers. New annual and lifetime loan limits will begin on July 1, 2026 for new students. Current students and borrowers are exempted from the new lending limits for up to 3 years. So if you are already in school, you'll have the existing access to the higher limits. With the new limits, higher limits are going to be set for professional students, meaning those who are pursuing degrees in like medicine and dentistry, for example. Graduate plus loans will be eliminated for new students on July 1, 2026. Again, current students are permitted to borrow Graduate Plus loans, though, for up to 3 years. The law also sets new caps on the federal student loans that parents can borrow to pay for their child's undergraduate education. So those are those Parent Plus loans. Prior to the new law, Parent Plus loan borrowers could borrow up to the total cost of attendance of their child's education, kind of minus any other financial aid they receive. But now that amount is severely limited. So in short, this bill limits access to federal student loans for parents and graduate students, which may drive more borrowers towards risky private student loans or limit access to higher education. In the long term, we anticipate more borrowers will likely struggle in repayment and may remain in debt longer due to private loans ineligibility for income-driven repayment and forgiveness programs. Speaking of forgiveness programs, when it comes to student loan forgiveness programs, we do want to note the RAP plan, the Repayment Assistance Plan, is the only new repayment plan eligible for public service loan forgiveness. So this is true for borrowers that take out any new loans or consolidate after July 1, 2026. They would only have access to RAP as an IDR plan, and for PSLF, you need access to RAP or to IDR. So one of the benefits for borrowers under the bill, the new law actually permanently extends the current tax exemption on student debt discharge due to death or total and permanent disability of a borrower. So those are two areas where there is actually a benefit from the bill. Finally, as it relates to student loans, the reconciliation bill puts the previous Trump administration regulations for borrower defense and closed school discharge regulations into effect until July 1, 2035. Okay, we know that's a lot of information. Remember that you are going to get a copy of the recording and the slides to reference, so you can go back and review what elements may be relevant to you. We're going to move forward and talk a little bit about what to consider in this new student loan landscape. We advise caution and careful thought for folks who may be considering taking out any federal student loans after July 1, 2026, and for folks considering consolidation. Borrowers considering taking out any new federal student loans after July 1, 2026 should know that they will only have access to the two new repayment options, the new standard plan and the RAP, and that these options are generally less generous than the plans that they may be currently enrolled in. In other words, ideally, borrowers should understand the new repayment options prior to taking out any new loans or consolidating after July 1, 2026. This includes loans for your own education or taking out Parent Plus loans. Borrowers considering consolidating their loans at this time should note that in some instances, consolidating your loans can reset your qualifying payment counts towards PSLF and IDR forgiveness. Borrowers should determine whether loan consolidation is the best option for the unique financial circumstances and can reach out to our office if you have questions about consolidating your loans. Okay, so for action items first, thank you for being here today to learn about these new changes. Since you're here, you already know that now is a good time to be evaluating your student loan repayment strategy, given all of this new information. So take some time to take it all in. Again, come back to these slides in the presentation as you review your situation. To help with that, we encourage folks to ensure you have access to your FSA account through studentaid.gov, as well as your student loan servicer account through their servicing website. Save copies of any and all communication or documentation you've received from FSA or from your servicer. That means printing, downloading, screenshotting, saving any information that you have essentially, and especially related to how many PSLF or IDR credits you already have, if applicable. We're encouraging borrowers to prepare for potentially higher monthly payments for the remaining IDR plans. This is especially true for borrowers still under the SAFE forbearance. At the time that they then will be entering repayment, they should anticipate higher payments. Parent Plus borrowers have some special items to consider. If your Parent Plus loans have not been consolidated and you want to consider consolidating, you may want to consider consolidating them if you would like to maintain access to income-driven repayment options. That means they'll need to consolidate and apply for, specifically right now, ICR repayment before July 1, 2026. We encourage these borrowers to leave plenty of time for consolidations to be completed well ahead of that July 1, 2026 date. All right, we know that folks have a lot of questions. Jessica and I kind of brainstormed in advance what we thought that might come up pretty frequently. So we're going to address some of these and try to demonstrate how you might think through some of these scenarios. First up, and I know I've already seen this question in the Q&A, I've submitted an IDR application months ago and it's not yet been processed. What do I do? Lots of folks are in this situation. There is a current backlog of still over 1 million manual IDR applications that are sitting with the student loan servicers waiting to be processed. We don't have an estimated timeline for how long it will take for these to be processed. So if you would like faster processing, we recommend resubmitting your application online using studentaid.gov. This will cancel the pending application and any associated documentation. But because you're submitting it online, you can then provide consent for the department to obtain your federal tax information, which is specifically your household size and income, directly from the IRS. And we have seen that this has resulted in faster processing for many folks.
All right, thank you, Amber. So this is a question, like I said, that we felt like a lot of people were going to have, right? And it's a question that we often get from borrowers that are submitting questions to us, to our office at this point in time. So should I get out of SAVE and apply for another income-driven repayment plan, right? So first, I want to mention that this is a personal decision and there is no universal right answer, right? With that in mind, here are some things that you can consider when making that decision. So you should consider getting out of SAVE if you want to continue receiving PSLF credits, you want to receive income-driven repayment credits, if you're close to PSLF or IDR forgiveness, with a special note that if you have reached 240 or 300 IDR credits needed for IDR forgiveness, you're going to need to switch into the income-based repayment plan, the IDR plan, to benefit from the IDR forgiveness, right? So these are the folks that should consider switching out of SAVE at this point in time. Now, you should consider sticking with SAVE if you would benefit from not having to make a payment, right? So like you have a personal financial situation where really, truly you cannot make a payment at this point in time, or you couldn't afford the higher payments that you might have to make under the other plans, then you might want to stick with SAVE, even though you know that you're not currently getting credit, right, towards PSLF or IDR. Again, you don't mind at this point in time receiving PSLF or IDR credits, and also you don't mind the interest accrue. Now I'm going to go back to Amber so that she can talk about the next question.
Perfect. And Jessica, can you hear me okay? I had to switch microphones.
Yes, you sound a little different, but I can hear you.
Okay. All right. Let's see here. So we haven't talked a whole lot about PSLF in this presentation, but one of the questions that we've seen come through our questions and complaints portal, and also some folks in the chat or in the Q&A here, is about PSLF buyback applications for folks who are still in the SAVE forbearance. So if you fall into this category, you currently have two options. One, you could do nothing and remain in the SAVE forbearance while waiting for your buyback application to be processed. This could be a good option if you want to potentially lower payment amount based on your previous IDR eligibility for the months that you want to buy back, or the lower income that you may have earned back in those months. And then also this could be a good option if you don't mind waiting a long time for the buyback process. We don't have an estimated amount of time for how long it's going to take for these applications to be processed. We do know that there's a backlog of, I think it's about 72,000 buyback applications. And based on kind of recent records, they processed about maybe 3,000 in the last month. So if you submitted a buyback application, it's in the queue. There's just an unknown amount of time it will take for it to be reviewed and processed. If you're in this situation, option 2 is to consider restarting repayments by submitting an IDR application to get out of the SAVE forbearance. This could be a good option if you only need a small number of payments and may end up getting forgiveness faster than waiting for that unknown amount of time for the buyback process. And also, if you don't mind making potentially higher payments for those months than the payments that you might have made on buying back earlier months. Again, if you had earlier, lower income earlier, your buyback amount might be less than if you were to buy the months that you have moving forward under a new IDR plan. But again, this is a personal decision. You'll need to decide what's right for you in your financial circumstances.
Thanks, Amber. And I just want to add, because somebody asked like a follow-up question related to this. Obviously, if you're not close to forgiveness at this point in time and you're thinking about buying back these months, I don't know, 3 years from now, when you're actually eligible for forgiveness, the situation at that point could be different, but we don't know, right? It's still possible that backlog might still exist at that point in time, and we can't really guarantee that you're going to be able to write back those months in a timely manner, right? So that's the reason why, if you are able to afford those payments and go back into repayment to continue accruing IDR credit at this point in time, it might be more advantageous for you to do so. Again, if you're comfortable starting repayment. All right. So the next question that we've been getting a lot is, should I consolidate my loans at this time? So for most borrowers, the answer is going to be no. Consolidation is not recommended due to potentially losing IDR and or PSLF credit. The only exception to this is if you have Parent Plus loans and you want to access income-driven repayment options, or you want to access the PSLF program, right? So in that case, if you have Parent Plus loans and you were trying to get into an IDR plan, you will want to consolidate your Parent Plus loans and apply for the income contingent repayment ICR plan by July 1st of 2026. So most people should probably not consolidate at this point in time, except for Parent Plus borrowers who want to get into an IDR plan. So.
All right, and we know we've mentioned Parent Plus loans quite a bit today. As you can tell, we're really concerned about these borrowers in particular. So what do you need to know if you are one of these borrowers who has Parent Plus loans? If you have not consolidated your Parent Plus loans and would like to enroll them in an income-driven repayment plan or anticipate needing to in the future, you'll need to complete your consolidation and apply for ICR before July 1, 2026. This is the only way that Parent Plus borrowers can access public service loan forgiveness and income-driven repayment forgiveness. If you've already consolidated your Parent Plus loans, so you had, 2, 3, 4 of them or whatever, and you consolidated and you're already on ICR, then note that you'll be moved eventually out of ICR into IBR by that July 1, 2028. If you are an existing Parent Plus borrower whose child is enrolled in a program by June 30th, 2026, you are exempt from that new borrowing cap for 3 years. But if you're taking out loans after that July 1, 2026, you have some things to consider, and Jessica's going to talk about those here on this next slide.
Thank you, Amber. So another question that parent borrowers might have at this point in time: my child will be going to college soon, right? How does this new reconciliation bill impact me as a Parent Plus borrower who is going to be taking out new loans for my child in the next few years? Well, if you're planning on taking out any of those new Parent Plus loans after that July 1st of 2026 date, you should keep in mind that you're going to have lending caps, right? You're only going to be able to borrow $20,000 per year per dependent, per child, and $65,000 total, right, per dependent child. You will also only have access to the new standard repayment plan, right, for your Parent Plus loans. And if you have Parent Plus loans right now, right? Even if they're consolidated, you're still, by basically taking out a new loan, you're going to change your eligibility to only have the new standard repayment plan available to you. So important for you to know, if you're currently pursuing IDR forgiveness or PSLF forgiveness, that just by taking out that new loan, you're basically giving away your right to continue being on an income-driven repayment plan, and as a result, getting income-driven repayment forgiveness or PSLF forgiveness. You will not have access under Parent Plus loans to any of the new IDR plans. And again, not be able to get forgiveness under those loans, and you also will likely be ineligible for PSLF forgiveness. So in short, right, you're going to want to think carefully through your repayment and forgiveness options as a parent before taking out any new Parent Plus loans after July 1st of 2026. And as a parent, if you're going to be taking out those loans, right, after July 1st of 2026, you want to make sure that you're comfortable making payments under that new standard repayment plan that is not as generous and will typically not qualify for forgiveness under PSLF.
All right, so our final FAQ question is, if you yourself will be attending college soon, this bill will certainly impact you. As a student taking out loans after July 1, 2026, you should consider that there's a new aggregate or lifetime loan limit of just over $250,000 for all borrowers, and that excludes Parent Plus loans. This is just if you're taking out for your own education. Grad students will have a lending cap of $20,500 per year with a $100,000 total lifetime limit. And then professional students, which is, there's not a hard definition yet for what's considered professional students, but we typically think of things like medical or dental or law school. Those students will have a lending cap of $50,000 per year with a $200,000 lifetime loan limit. Borrowers taking out loans after July 1, 2026 will only have access to those two new repayment options. And then the only other thing I'll note here is if you are an existing borrower and you're enrolled in a program by June 30th, 2026, that you are exempted from those new borrowing caps. And so that's kind of aimed at students partway through their schooling when those changes go into effect.
Thank you, Amber. But again, that is only for new borrowing caps, is not for your the repayment plans that are going to be available to you. If you take out any new loans after July 1st of 2026, you're only getting access to the WRAP plan and the new standard repayment plan. Okay, even if you have loans previous to that date. All right, so I know we have covered a lot of information to date, and you're likely not going to remember everything that we shared. So once again, the recording for this webinar is going to be available on our website in about a week, and will be sent to you once it is uploaded and available. In addition, just know that our office can assist Washingtonians like you in navigating your student loans if you still have questions after today. So just share a few of the resources that our office has. We have several pre-recorded webinars on a variety of student loan topics that are available on our Student Loan Advocate webpage. If you would like to know when we have new webinars available, actually by signing up to this webinar, you're going to get subscribed to our mailing list. So from now on, as long as you remain subscribed, you will get updates whenever our office has a new webinar available on a different student loan topic. And finally, if you need additional assistance after today with your student loans and would like to submit a complaint about your student loan servicer or ask us a question, you can use our form that's available on studentcomplaints.wa.gov. When you submit a complaint or a question, make sure to use the student loan questions and complaint form. And please note that we are working through a backlog that was accumulated earlier this year and continues to accumulate, unfortunately, because of all these changes, a lot of borrowers are asking for help. So it's currently taking us about 6 to 8 weeks to respond to borrowers once you submit your question. So you're going to have to be a little patient with our office to hear back. All right, so we wanted to invite you and anybody that you may know for an upcoming webinar specifically on public service loan forgiveness, or the PSLF program. So a lot of the questions that we're having today on this webinar are PSLF related. And we are going to try, since this is not a PSLF specific webinar, right? We're going to try to balance out questions about PSLFs versus questions that are not PSLF related, right? Just to make sure that we're getting everyone. But if you want to get an overview of the PSLF program and updates impacting specifically the PSLF program, I recommend that you sign up for this webinar, which you're going to get information about because you're in our mailing list. So it's going to be held on Wednesday, November 19th from 12 to 1:30 p.m. And if you're currently pursuing PSLF, or again, know someone who's interested in PSLF, feel free to share that with your networks to attend today. All right, that is all that we have for you right at the time that we were supposed to finish the presentation. So now we're going to be happy to take some questions from the Q&A. And once again, thank you for the opportunity to present today. So I will take it back to Amber so she can start choosing some questions to answer.
Perfect. And just a reminder, looks like folks have been kind of doing this throughout the presentation, but please use that thumbs up, upvote function as you're kind of looking through the question so that we can try to prioritize. And with that, so our highest upvoted question right now, my understanding is that people on the SAVE plan need to change to another IDR plan to be eligible for PSLF. For borrowers eligible for the buyback option, are buyback payments calculated based on the SAVE amount or the new payment plan someone has transferred to? So this is a good question. So, we kind of covered, right? Like if you're still on the SAVE forbearance, what your options are. You may still be available to, sorry, I got distracted from something that popped up. For the buyback, right? So when someone is going to buy back time, so the time that they buy back could be the time spent in the SAVE forbearance, or it could be from other forbearances and deferments that they may have had previously. So generally they're going to look to see what your, if you were on an IDR plan, what the plan was during that time period. We have heard that SAVE, because of the injunction, they may not be able to use the SAVE monthly calculations, but they could request your tax information for that particular year and look at that. So there's kind of a lot of variables in that, but it may not necessarily be, the newest payment amount that you have now. It should be more akin to what your income was then. Jessica, with that, do you have anything else to add to that? Okay. Do you want to take the next non-PSLF question?
Sure. So I know that there was somebody that just asked for general updates on PSLF. The program still exists and nothing has really changed when it comes to PSLF, right? That's basically all you need to know. My recommendation is if you want to deep dive on this, you might want to attend our webinar on PSLF. So hopefully that answers your question. Still exists, nothing has changed about PSLF specifically. A lot has changed about income-driven repayments, but not PSLF specifically. So if somebody is in the SAVE forbearance and wants to apply for IDR to try to resume payments, do we have to wait to resume payments until they process the application since there is a backlog? Yes, right? If you submit an application today or you submitted one in the past, right? You have to wait until they until they process your application and you actually are into an income-driven repayment plan before you can continue making progress towards forgiveness. Now, again, like we explained earlier, if you submitted an IDR application earlier this year or maybe late last year and you still have not heard back and you really want to go back to making payments, our recommendation right now is that you submit a new application on the studentaid.gov website, and that you choose the option to share your tax information directly from the IRS to the Department of Education, and that will hopefully lead your application to be processed faster. We have worked with a lot of borrowers that have done that process and were approved in a matter of weeks. So we're hopeful that this will be a solution for a lot of people that are trying to enter repayment and have been waiting on that backlog for a long time.
And I'm going to add to that too, is that, if you make a voluntary payment when you don't have a payment due, so if you're on the Save Forbearance and you make a payment, that payment is not going to count towards PSLF or towards IDR forgiveness. It's only when you have a payment due. So please keep that in mind. Let's see. I'm going to jump down because there's I think we had a typo on a slide that's confusing some folks, and I want to make sure that we clarify that. So, this one says slide 14 says PSLF and IDR credits are not being granted for any time spent in SAVE. Does that mean only while in the forbearance, or payments that are made in the SAVE plan prior to the plan being blocked are not also going to count towards PSLF anymore? It is the Save Forbearance specifically. So thank you to Megan and a couple other folks who brought that up. It is the time spent in the Save Forbearance is not counting towards PSLF. If you've previously made payments while you were on the Save plan and they already show as qualifying in your PSLF progress tracker, there's no reason to assume that anything would happen to those, that they wouldn't be qualifying, right? They should still be qualifying. So please, if that was a concern of yours based on what was on our slide, please know that it is fine. Those payments should be safe. It's just the Save Forbearance. And as of right now, the Save Forbearance is eligible for PSLF buyback. So you might still be able to get credit for those months. It's just you're not actively getting credit. It's using the buyback process in the future.
All right. So and I have another question that is PSLF related, but really applies to a lot of people, right? So I'm going to go ahead and read it. So if someone was on the SAVE plan as part of the litigation pause, but submitted a request to move to another plan, do the time spent waiting for processing count towards PSLF? And I'm going to make it broader to PSLF/IDR forgiveness, right? So that this to answer this question, also for people that are working towards IDR forgiveness. Specifically, does it switch to an administrative forbearance and therefore count towards PSLF? So the answer to this is complicated, right? So after you submit an application right now, or in the past, more right now, not necessarily, because they're typically processing those applications that are submitted right now much faster, right? But if you've been on the backlog and you have applied to switch into another repayment plan, you are actually placed for the first 60 days after you apply into an administrative forbearance, right? The 60 days that you spend, or those 2 months, right, that you spend on administrative forbearance will actually count towards PSLF. The issue is after those 60 days, right? So after those 60 days, you actually, regardless of whether you apply to get into SAVE or to switch to another repayment plan, you are being placed on that SAVE forbearance and you're not getting credit for PSLF, right? So to answer your question, you get credit for 2 months basically after you submitted your application, but after that, if your application has not been processed, you're automatically placed into that SAVE forbearance and you're not getting credit towards PSLF or IDR.
Sorry, I realized I marked the one that you just answered as answered, and then I think you went to do it and then click the next question. So I'm trying to find that next question. Here we go. Okay. I'm in the Save Forbearance on PSLF track. Will reach 120 payments in June 2026. I've read not to do anything right now. Is this correct? How does the buyback option work if I'm still in forbearance when I hit my 120 months? How would my payments be calculated? I haven't had to recertify since before the pandemic. So it's up to you whether or not you decide to stay in the Save Forbearance right now or to apply to switch into a different IDR option to start making payments that are going to actively start counting towards PSLF. The buyback option, I mean, as far as utilizing buyback, if you're still in forbearance when you hit your 120 months of employment, the process doesn't work any differently, right? You still submit your buyback application for those months as you would for any other months, whether you were making active payments or not. When you apply for buyback, you only have to continue making payments if you have a payment due at the time that you apply. So if you're in a forbearance, you don't have a payment due, you don't necessarily have to keep making payments because you weren't before you applied. The payments are calculated based on the your income essentially right at the time of those forbearances. There's a lot more detail about if you were on an IDR plan before the forbearance or after the forbearance, or if you don't have an IDR plan and you need to submit documents for your taxes, there's a lot more information on the PSLF buyback page. We're going to cover that more extensively in our November webinar on PSLF, so I don't want to get too far into those details. But I recommend going back and looking at our slide about, if you're in the safe forbearance, what options you have. So to review that information.
Thank you. And again, I do want to emphasize, as we talked about this earlier, the issue is that we don't know when you apply for buyback how long you're going to be waiting, right? So if your priority is to get forgiveness as fast as possible, right, it might benefit you to just go ahead and start repayment again if you're able to do so. All right, next question. When we vote the people into office, the new president and congressional leadership who prioritize public service and making the United States better for working people, can the new president, House, and Senate overturn the regressive, destructive, big, beautiful bill impacts of the Department of Education and the student loan programs, as well as other disastrous impacts? Can a version of states being restated at that time? Potentially, yes. This is very theoretical question, right? Like, I don't want anybody to make decisions based on this potential, right? Could everything with the new Congress in the new president potentially be, basically reversed, or new legislation passed that has more generous terms for borrowers? Yes. Should we count on that happening? No. Make your decisions based on the current situation and the current regulations that are in place. And then if this comes to pass, then we can all celebrate at that point. Okay. Thank you.
All right. So the next question, I have also found Mohila to be very difficult to contact or get information about all of these changes. That is not surprising. So, right. So the bill passed, and so we know kind of what's going to happen. But the regulations that kind of operationalize how the elements of the bill are going to be put into place, that process is just starting. And so the servicers take their cue on how to answer questions from the department. And so because the regulations specific to all these changes that are going to be happening from the reconciliation bill are not yet in place, the servicers likely don't have answers. They might have just a standard, contact the department or wait and see. They may not have helpful information. So, the information that we're providing here is based on ours and other experts reading through an understanding of all of the elements of the bill, but, we don't yet have access to what the regulation language is actually going to look like.
Perfect. So next question is, I have only had 2 months left to reach PSLF for almost a year, but can't get those last 2 months of credit because I can't make any headway on getting approval for a repayment plan. I also don't want to have to pay the interest, which started August, because I should have had these loans forgiven already. Will that interest be forgiven as well? Under PSLF, yes. Whatever is the balance at the moment that you get forgiveness, regardless of how much the interest is, it will be forgiven, right? Now, to your question about trying to switch to a new repayment plan, if you have not done so already, my recommendation to you at this point in time would be to reapply. right, on the studentaid.gov website and share your tax information. If you've already done that and you're still waiting for more than 60 days, let us know. And again, waiting for more than 60 days since you reapplied, right? Not from the original application. Let us know. But yes, that would be my suggestion to you, is to just go ahead and reapply on the studentaid.gov website and share that tax information, and hopefully you'll be able to re-enter repayment and make those payments to get forgiveness soon. Crossing my fingers for you.
All right, I just refreshed my upvotes. Is there any way to have individual counseling regarding student loan debt and options or resources / groups? Great question. So if you feel like you have a really complicated situation, you can submit a question or complaint to our office to try to assist. We know that there's a lot of information. I do recommend kind of going back through and reviewing this presentation, maybe first taking a look at your loans and getting a sense of where they're at first, and then come back and see how what we're saying here might apply. So as far as other resources, there's other, I would say, like, reliable sources of information. There's some nonprofit advocacy groups that, we work with. The Student Debt Crisis Center often has webinars similar to ours. Protect Borrowers, previously known as the Student Borrower Protection Center, does a lot of great work and advocacy and information related to student loans. There's others, but I'm blanking right now. Jessica, if you've got others you want to share.
No, I think those two are good. And I will say, right, we are not financial counselors or legal advisors. So if you reach out to us about your situation, just know that we're just going to provide you with the choices that you have available. We're never going to tell you what to do, right? A lot of people, when they're reaching out to our office, they're looking for a definite answer on, like, what is the exact thing that I can do in my situation. And we oftentimes don't have that answer, right? Like, we're just going to explain to you your options, and then you'll have to make that decision, right? On how to move forward. So I just want to make sure that I explain to people, how our office works, so that, hopefully nobody reaches out to us and gets their hopes up on, that we're going to be able to give you a specific roadmap, unless you have a general question, right? If you have a general question, then we can give you a roadmap. But if there's multiple options available to you, all we can do is explain to you your options, and you're the one that has to decide what the best option is for you.
And we do know, there are questions that we have that are not yet answered, or there's still things that could change. We can all only do as best as we can with the information we have in the moment. So, take that as you will. All right. I think we already answered this one. The application for buyback program has been in adjudication since November. Yeah, we don't know how long it's going to take. You could potentially apply to switch to another income-driven repayment plan to start making payments again. What is the likelihood of PSLF being around for the next 5 to 10 years? Well, none of us have a crystal ball. To my knowledge, there isn't a big push to remove PSLF as a program. We are noticing, right, that there's, with the reconciliation bill, access to PSLF might be harder, right? Especially we know that the Parent Plus borrowers that may borrow after July 1, 2026, they're going to essentially lose out on access to PSLF. But specifically in the reconciliation bill, the RAP plan that's created explicitly has been noted that it counts for PSLF. We're, as of right now, not aware of, any big push to get rid of the program. It would be kind of an unpopular position, I guess, for an elected official to take, given how much support there generally is for PSLF. But anything can happen, unfortunately.
And just so folks know, I am typing that we have answered live to questions that we've already answered, right? Just so that we can keep going. We're likely not going to be able to answer all the questions. There are 132 questions, right, that were submitted. So if you can use the upvote feature, that helps us, right, to figure out what we can answer in the next 12 minutes here. So Next question. If I'm enrolled in the PSLF program and I am in the payee program, I think you mean the payee repayment plan. Do we still have to enroll in a new plan before July 1st of 2028? The answer is no. You could choose to stay in payee until July 1st of 2028. You might want to at least take a look at what your income-based repayment and or RAP payment would be, close to that date, so that hopefully, if you're switching to RAP, you're not surprised by the monthly payments. So you can stay there, but I would recommend that you at least investigate what your monthly payments are going to be before then, so that you're prepared, right? Because it's for income-based repayment, you're most likely going to have a very similar payment that you have in payee, but for RAP, if you get automatically rolled into that, which may happen right after July 1st of 2028, it might be a higher monthly payment. So you can stay in payee, but look at your other options just to make sure that you're prepared ahead of that date.
And just to add on that, because I might have missed it, just, if you stay on payee at that time that you get to July 1, 2028, you'll be transitioned into RAP automatically. We don't know what that looks like precisely or when that transition occurs, but at that point, essentially, the access to payee ends. Okay. Do you have to pay taxes on the amount forgiven through PSLF? No. So forgiveness under PSLF is not taxable federally. State-wise, that could be different, but there's only a couple states that would potentially tax, and Washington is not one of them. So forgiveness under PSLF is not taxed, is not considered income for your taxes.
Perfect. So what happens when you have loans before 2014 and after 2014? I guess I don't know what your specific question is, right? I'm guessing you're asking about repayment options. Basically, your repayment options are going to be what we talked about prior to July 1st of 2026, right? So like that bucket of folks, as long as you don't take out any loans after July 1st of 2026. So hopefully that answers your question.
Yeah, with that one, I think it might really only be relevant to like if you're on IBR that has kind of pre-2014 and post-2014 rules. But I assume that in the calculation of your payments, they calculate each individual loan and then add that up for your monthly payment. And so, if that's the plan you're on, it may just calculate, those payment amounts based on when those loans were taken out. Okay, so my loan servicer provider, Mohila, says anything related to PSLF now goes through studentaid.gov. I've been told by student aid to look into the buyback program if I'm less than 12 months away from the 120 qualifying payments, and my loans are in the forbearance for the SAVE plan. If I change my repayment plan to an IDR plan to count towards qualifying payments, will I lose 12 plus months of qualifying payments that would have counted prior to the federal court injunction? So no, yeah, you can continue to make payments and also have submitted a buyback application for those months. Like you can do both processes simultaneously, and then just whatever happens first, right, you take.
Perfect. If you're on the SAFE plan and have continued to make payments regardless of the forbearance, do they still not count towards PSLF? Oh, no, 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 no. Please stop making payments right now. Stop making payments. If you have made any payments during the SAFE forbearance and you are on the SAFE forbearance, please stop making payments. Apply to switch to a new IDR right now. Unfortunately, if you made any payments while you were in the SAFE forbearance, those payments are not going to count towards PSLF or IDR. So I'm sorry.
Okay. Can you clarify, will everyone be on RAP no matter when loans were taken out by July 1, 2028, or do legacy borrowers still have legacy options after July 1, 2028? Great question. So let's separate out again the new borrowers versus current borrowers. New borrowers, if they take out loans after July 1, 2028, They're only going to have access to RAP and the new standard repayment plan. Okay. Legacy borrowers right now for income-driven repayment may have access to ICR, IBR, and payee. If you're on those plans, so IBR, if you're on IBR, you can continue on IBR past July 1, 2028. You can stay on IBR. That particular plan is protected in statute and is still going to be around for legacy borrowers. So you can stay in IBR past July 1, 2028. It's ICR and payee, or pay, however you want to say it. Those two plans will be sunsetting on that July 1, 2028. And so you'd want to kind of look at, is it better for you to switch into IBR or RAP if you are still on those plans as we approach that July 1, 2028? I think that succinctly covers it. I know, it's complicated. We debated how to present this information because it is so complex, and we recognize that. And, you know, supposedly this is going to simplify things, but it really only simplifies things for new borrowers. For everyone else, it's more complicated.
I mean, it simplifies things for new borrowers at the cost of losing generous repayment plans.
Yes, for sure.
So that's the other thing, right? Like, for most borrowers, the new stuff is not good news, right? Whether you're an old legacy borrower, a new borrower, unfortunately, you're going to have, for the most part, less generous options. So are there legacy, standard, or alternative repayment plans PSLF eligible? Typically not, right? None of the alternative repayment plans are eligible for PSLF. And of the standard repayment plans, only the 10-year standard repayment plan is eligible for PSLF. Okay, so the answer is no. Most of them don't count. The only one that counts is the 10-year standard repayment plan.
This is I think a really important question. Do borrowers have any recourse for the ongoing and frustrating problem of receiving conflicting information from servicer employees, FSA, etc.? Just student complaints? So there's a couple things. So if you're getting misinformation from your student loan servicer, right? So if you call Mohila, you call Nelnet, Advantage, Ed Financial, or CRI, those are the current servicers for direct loans. If you are getting misinformation or wrong information, inaccurate information from those, please submit a complaint to our office. We can forward that to DFI for further investigation. For federal student aid, right, we don't have the power to regulate the federal government. Your options would be to submit an FSA feedback complaint. Please do that. You know, even if it may not go anywhere, we know there's a huge backlog of those complaints. But you also can contact your representatives in Congress and file a complaint with them and share what your experience was. They're kind of the only ones that have any sort of oversight into federal agencies. So there's that distinction between servicers and the federal government, specifically FSA, which falls under the Department of Education. So those would be kind of your avenues for those different complaints.
And I also want to say another avenue that you can submit a complaint about federal student aid, about the Department of Education, is to the Washington State Attorney General's office, right? They obviously don't take action on individual complaints, but they do gather information on, any kind of pattern of complaints that are being received about any specific party, and will act on behalf of Washingtonians. So again, if you have a complaint specifically about Department of Education or federal student aid, the Washington State Attorney General's office could be another resource.
I know we only have a couple minutes here. Here's what I see. The IDR plans are what qualify for PSLF. PSLF is not blocked like payee and ICR forgiveness. That is correct. So PSLF is its own program. It exists separate from the income-driven repayment plans. It's just being on an income-driven repayment plan is essentially required to earn credits towards PSLF. So PSLF hasn't essentially changed at this point. It's just there's issues with the different repayment plans, as we have covered extensively.
All right, we only have a couple of minutes here, and a lot of these questions are very specific. So I'm going to be, unfortunately, skipping those and try to get to some more general questions, right? Give me 1 second. So somebody asked, is there a deadline to submit an application for buybacks? Will it become unavailable at some point? Thanks. So there is no deadline, right, for you to submit a buyback application. Whether it will go away or not in the future depends on regulations, right? So it could change. So we don't know the answer to that. As of right now, there's no deadline. You can submit a buyback application at any point, as long as you would have reached 120 qualifying payments by buyback months that you were in a forbearance or a deferment.
Jessica, I think this is probably a good one for our last question. Does the Washington Student Loan Advocate have an actual phone number without having to submit a complaint form to get addressed? Do you want to talk a little bit about our process when we receive complaints and phone versus email or versus our form?
Of course. So while we do have a phone number available, right, we still need people to submit the complaint, submit a complaint in the complaint portal to get help. When you call in, you're going to be placed in the same queue as everybody else, right? We don't give attention to people that call first, right? You're entered on the same queue. And when we call you, we're going to have to ask you the exact same questions that we ask you on the complaint form. So if you want to save yourself time in our office time and just make the process smooth, it is on your best interest to just go ahead and submit a complaint form. If you have a disability, right, that prevents you from completing or makes it challenging for you to complete the complaint form, you can still call us and then we'll call you back. But again, you're going to be placed on the same line as everybody else. And the amount of time that is going to take for us to call you back is the same as everybody else, right? That is on the complaint queue. So yes, there is a phone number available. Unless you have a disability, I discourage you from using that. And I would prefer that you use the complaint form because we're going to have to ask you those questions anyway in order to be able to assist you. So that's the short on how our complaint process works and your options to reach out.
And I would just add too that, when you call, generally call like Wasac's help general line and there's an option for our office. We generally don't answer that line live. We let it go to voicemail so that those folks get into our queue and we have that voicemail to refer back to. So, just because of the nature of we're always, in meetings with borrowers and meetings with other folks that do similar things to the work that we do. And, just there's so many sorts of things that, it's not like you're going to get through to a live person. Our office is literally just myself and Jessica. So, we do our absolute best to get back to you guys as soon as we humanly can. So, we hear you and see you and just know, like, we are real people. If you submit a complaint to our office, like, we are going to get back to you. We don't, those don't disappear into the ether. We do look at them. So, please know that and be reassured that, even if you can't talk to a human, it's somewhere else. Like we are around and we are trying to do our best for you. So, thank you all for being here today. We really appreciate it. As a reminder, we are going to send out this recording as well as the slides via email within the next week. We'll also post it on our website for reference. So please check back, review it as you need. And we're happy that we can be a resource for you all.
Thank you, Amber, and thank you everyone once again for attending. And we'll hopefully see you back again at one of our upcoming webinars. Bye.